Hey guys, first thing we want to do is let's check video audio. If you can hear me or if you can see me sharing my screen, there is a chat box. Let me just open it up, and if you can just let me know that you can hear me. Um, all right, it looks like we are good to go. So first thing, sorry, I tried to use a different software for this meeting, and for some reason it wasn't working. It wasn't picking up my microphone. I don't have a camera on the computer that I'm using right now, so maybe that was the issue. But we'll try to solve that and see if we can use Webinar Jam maybe for next time. But what we're going to do is we're just going to go through positions that we have open for Income Navigator, as well as Daily Nut. And if you guys have any questions, if you have any specific questions about any particular trade, this is a great opportunity for you to ask the questions, and maybe we could discuss some of the topics that we don't talk about because it doesn't really come up in the chat during the day. So we have a couple of positions on. Let's just start with, we have a couple of iron condors. So we have one in December. That's 13 December. And it is currently unbalanced. We were able to close a half of our short call spreads, and with such strong move in the SPX over the last 42 days, this has been one of the, I don't want to say most difficult, but it has been a very challenging position to hold, especially on the upside. We had rolled our puts several times, and that offset ultimately any unrealized losses on the call side. And eventually, if and when we see SPX revert a little bit, maybe we'll see a bit of a pullback. This position is going to pay out really, really fast. We have 17 days left in this trade. We've been in this trade for 42 days. SPX has moved about 1.26 standard deviations. And, it sounds like a lot, but it isn't, because, if we look back to where this trade started and where implied volatility was, and the kind of a move that was being priced in based on that implied volatility, it wasn't already implying much. So we have seen a move. Let me see. So when we started this trade, SPX was at about 3,000, just over 3,000. And as we are looking at it, we're about 140 points higher. So, we have seen a move of about 5% to the upside in the last 42 days. Is that a significant move? I think it is. But, if we look back at how often do we move, somewhere in the line of 5% in one direction over a 40-day period, I don't think this is something that we have never seen before. So this does happen a lot often than it should. But the point is that if we have a good trading plan for any position, it really doesn't make a difference of what the underlying market is going to do. As long as we have a good plan and we stick to it, we should be able to successfully navigate any income trade. So this position started 42 days ago. We saw a pretty strong non-reverting volatility to the upside, and we have rolled the puts up several times. We have closed half of our short calls, and we are currently sitting at a slight profit. And I think that the game plan for this trade would be that if we're going to continue to see a move to the upside, I don't think that there is a whole lot of adjusting to do. Any adjustment that's going to be made, it's going to be a debit, which means that it's going to reduce the amount of credit we have collected. And we have a fairly healthy amount of credit here. We have just over $2 per one contract in credit. So we could spend some of this credit to make adjustments, but with 17 days to go, there's really not a whole lot that we can do. If we were to look to maybe roll the 3170, 3180, so if we were to close this call spread and roll it up to maybe 3200, right, and increase size to full, so 3200, 3210, it's still going to be a debit, which will leave about $1.50 of net credit in the trade. But as we can see here, we don't really get any kind of protection from any further move to the upside. So I think it's a lot easier to maybe just define our stop loss and say, you know what, if SPX continues to trade towards 3200, maybe if it crosses 3160 or 3170 or whatever that point may be, or maybe it could be the short strike on the upside, so 3170. So if SPX goes to 3170, we're just going to cut this trade and move on. Right? I don't want to do it. I want to stay in this trade, and but at the same time, I'm not going to allow SPX to run this trade over. And if I'm going to take a loss, I want to make sure that the loss is somewhat acceptable. I don't want to see SPX go over 3170, 3180, and then sit there kind of hoping that we're going to see price action to the downside so that the trade come back. I'm going to put a hard stop at 3170. If we get there, be it. But if we do see some kind of reversion over the next couple of weeks, we could probably get out of this trade with a. I think we could potentially get out of this trade with about $1 profit. So I don't know if there's a delay here. I'm going to guess there is, but it shouldn't be significant. As we are talking about this specific trade, if you have questions, put it in the chat box. All right, so we'll move on to the next iron condor we have. We put this on not too long ago. Let's see. So this is in January. This trade has 52 days to go. We've been in this for 5 days, and we can see that over the last 5 days, SPX has already moved over 1 standard deviation. Again, it sounds like a lot, and maybe it feels like a lot, but the reality is that volatility is so low that it's not a move in one direction of 1.12 standard deviations in 5 days is not a significant move right now. What I am kind of surprised to see is that we have seen a move since we put this trade on. When we entered this trade, SPX was at 3105. So we saw about a 35-point move in one direction in the week. And this trade is currently, it's at about a break even. So there's really not a whole lot of drawdown going. I looked at each side of this iron condor and where the credits are right now. And while the call spread has accumulated in value, we saw a good drop in the value of the puts, so that kind of offsets. And the plan for this trade would be, if we're going to continue to see a move to the upside, I think the best way to play this, when 32.55 call delta, which is currently 14, when this call delta gets to about 20, maybe 22, we're going to look to add out of the money options, specifically out of the money calls, to reduce our net delta. And that's going to potentially remove some of the upside risk if we're going to see further upside in the SPX. So, for example, when I say net delta, I mean delta of all options combined, right? So for right now, this is a 10 lot, and this position net delta is minus 15, which makes it about minus 1.5 for every one iron condor. So if, let's say, 32.55 was a delta 20 right now, and this was time for me to make an adjustment, what I want to do is, let's say I wanted to remove half of my net delta, which is minus 15. I would need to look for a call with a delta of 7, and adding a positive 7 to this negative 15 will reduce my negative 15 by 7, which will bring my net delta from minus 15 to minus 8. And as we can see here, all right, this is the T plus 0 line before adjustments. And by bringing in an out of the money call, my T plus 0 line is going to be just a little bit smoother on the upside. So if we're going to continue to see SPX trade towards 3,200, instead of accumulating losses on the way down, this out of the money call is going to help offset some of that loss. Right, so that's the plan. If we're going to see SPX trade higher and short call delta reaches about 20, so that's the trigger. When delta of a short call goes to 20, that's going to trigger an adjustment, and the adjustment is going to be take my net delta and look for a way to cut it in half, maybe by 2/3. So if my delta is minus, when 32.55 call reaches delta 20, my net delta of this iron condor is probably going to be somewhere in the neighborhood of minus 27, maybe minus 30. So what I'm going to look to do is I'm going to look to remove about 15 to 20 deltas off my position. So I'm going to go out and look for a call with a delta 20 that's going to help me reduce my net delta from minus 30 down to minus 10. Right, and on the downside, let's say SPX starts to trade lower, I'm going to look for my short put on the downside, which is currently delta of minus 10. When this put goes to about minus 23, minus 25, that's also going to trigger an adjustment. And the adjustment is going to be reduce my net delta from whatever my delta is going to be at that point. It's probably going to be somewhere in a neighborhood of plus 15, right? So I'm going to go from plus 15 and look to cut my delta to about plus 7, which means that I will have to look to buy a put with delta of about 8. All right, so those two are the iron condors, and we have more information about how we approach these iron condors. If you go to on the website, if you go to new member orientation, there is one of those 4 steps, I believe. There's a trade playbook, and in one of the very last step is we outline every single trade that we do. So one of those being IC base, which is just a plain iron condor, and we talk about trade selection, and we look at entry, we look at exit, and then we go into a couple of different adjustments. So everything we just talked about, everything is in that. Everything is in that section. So I'm going to copy and paste into the chat, so everyone that's a member can go and check it out. And if you have any questions, you can contact me inside the Slack, and we can talk a little bit more about adjustments. So now we're going to look at 2 other positions that we have in Income Navigator, which is going to be, there's nothing really special about entry or trade management of these naked short options. We sold an out of the money put in Tesla. This is a very short-term trade. This trade only has 10 days, so I don't really care if Tesla goes higher or if Tesla goes sideways, or I only care about Tesla not going much lower than 315 over the next week, maybe a week and a half. And if that happens, I'm planning on rolling out this trade. I don't know exactly to what strike I'm going to roll, but my goal is going to be to roll it for a net credit. So most likely, if we see Tesla trade down to about 315, 312, I'm going to buy to close my 310 for whatever it's trading, and I'm going to look to roll to the following week. And it's probably going to be 5 points lower, and the credit is probably going to be 25 cents, maybe 30 cents. So that's my plan for the trade. And if Tesla continues to trade lower, I'm not going to allow the option or the price to go much lower than my short strike. I'm just going to probably cut my losses and move on. So it's very simple. I mean, I wish there was some fancy adjustments or fancy triggers to enter or to exit the trade, but there really isn't. This is a kind of mechanical approach. I have a I guess a bullish outlook on Tesla over short term, and if I'm right, 310 is going to hold. If I'm wrong and Tesla goes lower, I'm going to roll it, and maybe I'll roll again. And if if I'm proven wrong, I'm just going to cut the trade and move on. So that's the plan for Tesla. Similar with Netflix, except this is a neutral trade. I don't care if Netflix goes higher or if Netflix goes lower. This trade has 17 days until expiration, so we're probably going to be in it for a week, maybe a little bit more. As long as we don't see a big move in either direction, I think we should be able to get out of this trade with at least 40 to 50% of credit that we were able to collect. And if we're going to see Netflix trade down to maybe 300, right? I'm going to look at where my short 295 is. Looking to make adjustments by potentially rolling my tested side, right? So if we see Netflix down at 300 and my 295 put delta is 35, maybe 37, I will buy to close 295 and look to sell to open something in the following week's expiration. I'm going to look to collect a net credit on that roll, and I will probably just close out my 335 call and hold off on selling anything on the upside unless we see a much more aggressive move to the downside, and then I could potentially use short calls to control my net delta of this position. But step number one would be to close out the 295 and sell to open something in the following week and collect the net credit on that adjustment. And then we have we have a broken wing butterfly. There's really not a whole lot going on other than we were able to scale into this trade. All three tiers are on fairly quick, right? We've been in this trade for 8 days. The underlying has moved 1 standard deviation higher. Implied volatility came in a little bit. We were able to scale into all 3 tiers as planned. And now the next step is going to be if Russell continues to trade higher and we see a move about 30 points above the center of tier 3, which is currently centered at 1610. So a move to about 1630, 1640 will trigger my next adjustment, which would be removing tier 1 and opening another broken wing put butterfly that's going to be centered 20 points above my current tier 3. So everything is going to get shifted by 20 points. So 1570 put butterfly is going to be closed, and I'm going to look to open a 1630, which is going to become the new tier 3. And then the current tier 2 is going to become tier 1. Current tier 3 is going to become tier 2. And then if we're going to continue to see move to the upside, which I think we may, Russell failed at about 1630 last couple of times it tried. And if we don't see if we don't see sellers come in and buyers are able to take this, let's see. So we have the next captain obvious level would be somewhere around 1700. So if we're going to see a move towards 1700, instead of rolling and rolling and rolling, I'm going to look to utilize out of the money call calendars, and I'm probably going to have to remove some of these butterflies that are currently centered at 1570 and 1590. The reason why I would look to take these off is because they are currently adding net negative delta to this position. So if Russell is running away on the upside, I don't really have much use for that negative delta unless I'm looking for a very strong reversion, which is probably not going to happen. Again, these are my thoughts, or this is what I think is going to happen. If I'm wrong, I also have a plan, and the plan is pretty straightforward. We scaled in. If we are going to see the price run away and trade outside of the tent, we can roll once, maybe twice, and then after that, I'm going to use call calendars to extend the tent to the right. And eventually, what I do need is I need the price come back into the tent. So I don't want to let the price run away too far from the tent. So I'm going to use my best guess as to where the price may be headed, and I will use whatever techniques I can to keep my entire structure not too far away from the price. But then eventually I will need the price come back into the tent, and that's how this trade is going to make money. There are a good handful of these trades that we have done, especially recently. They're all on the website. They're all on the forum. I highly suggest that anyone that's interested in learning how to trade this, broken wing, butterfly, and Russell, there's a lot of information that's there. So I suggest that you take the time and go through it. And if you have any questions about any specific adjustments that were made, those would be great topics for discussion. But a lot of that information is pretty straightforward. We set up the trade plan before we get into the trade, and then we try to stay as close to that plan as possible. So there's a question is if there's a timeline associated when I will have to remove the lower end butterflies. And I guess there is no, and I don't like to pivot any of the adjustments based on some sort of a timeline, meaning at 30 days to expiration, you do X. At 35 days to expiration, you do Y. I'm more focused on price, where price is. So if Russell is trading at 1700, there's a very good chance that my butterflies that are centered at 1570 are probably going to expire for a max loss, as long as we don't see that price come back towards 1570. So if Russell is trading at 1700, and it's probably a good idea to remove some of those butterflies that are way too far out of the money, because there's a very good chance that they're working against us. So to answer the question, there is no timeline. As far as timeline goes, I do want to be out of the position somewhere around 21 days or less. Reason being is if, let's say, we have Russell that goes, let's say it goes here and then trades sideways, and then it goes back inside of the tent. We can see that over time, T plus 0 line is going to get really, really steep, especially here around the edges of this tent. So I would like to avoid riding up or down the slope. So if I can get out of this trade somewhere, let's see, this dark gray line. This is the line, right? This is T plus 0 at about 26 DTE. Right, so it's still fairly smooth, but then the longer we stay, the more T plus 0 is going to morph into this. And this is just going to become hard to hold unless you're willing to commit and monitor the trade. You know, I'd like to not spend the whole day in front of my computer watching this trade tick by tick. So that's why I'd rather get out of this trade with 20 days to expiration instead of holding it all the way through to expiration, because eventually, if we don't exit, right, this T plus 0 line is going to become this, where a 5-point move can take your P&L, right, from being up, I don't know, 7,000 to up 5,000, and it doesn't take much. So I want to avoid staying in this trade for too long. I'd rather get out of this trade with 20 days, 25 days, and look to move on to the next trade. So those are the positions in the Income Navigator. We have time to go through position in the Mr. Daily Nut. Let me just remove all these lines. So this is our weekly income calendar that is currently showing a loss of about 8%. And this is probably a good time to bail on this trade. We started at 31.10. The price continued to move through 31.30. That triggered the second at the money put calendar, and now the price is moving towards the edge of this structure. And I could sit here and tell you that we are due for some sort of mean reversion, and we probably are. And the fact that I'm considering stopping out of this trade is probably a good enough indicator that we are going to see some sort of back and fill. But I don't want to let this trade get too far away from me. I'm going to probably look to exit out of this trade by first closing out my 31.10 and then closing out the 31.30 put calendars while the loss is still fairly manageable, and I'm going to focus on other positions. One position that we have been putting on, and we had removed a couple of positions, so they're all very similar, so we don't need to go through each and every single one of them. We have several variations of this trade that are going around. One of our members, Tom, has picked this trade up, and he's tried a couple of different variations, and I trade very similar but slightly different variation of this trade. Basically, this is an out of the money put condor, right, where we're using an out of the money put debit spread with an out of the money put credit spread, and the credit spread is larger than the put debit spread, and this trade results in a net credit to enter. But very neat thing about this trade is that if we hold this trade long enough, we can actually exit this trade for more than what the initial credit was. And that will happen because we have, let's just assume that the underlying is SPX, and we see a move to about 3070 with 4 days to go, right? As price moves inside of the body of this put condor, we have a put debit spread, which is 10 points wide. And at 3070, this put debit spread is going to be worth probably 6, right? Our put credit spread is it's not going to be worth 0 because there's still going to be 4 days to expiration, but a significant amount of premium is going to decay. So we're going to actually end up making money on both sides. We're going to make money on the put spread, on the put debit spread, and on the put credit spread. So if we enter this trade for a $40 credit at 3070, we could get out of this trade for about 380 credit. So, and we have a couple of other positions. They're all the same. I'm not going to go through every single one of them. So we have one like this. We have one that looks like this. I mean, they're all almost at their max potential, aside from going into the body of this structure, which is between the debit spread and the credit spread. And the last trade that we put on earlier today, which also looks pretty good as long as SPX, and all of these trades are all done in SPX, and as long as we stay above the long put of the put debit spread, we have a potential to keep all of the credit that we collected at entry. And the bonus of this trade is that if we are somewhere inside of this put condor with 1 or 2 days to expiration, we could potentially make more than what the credit was to enter this trade. So these are the positions that we have on right now. We took off a bunch of positions, so there's really not a whole there is not a whole lot of positions to talk about. We're going to pause here, and we are going to continue. We're going to continue this conversation. We're probably going to try to do this weekly. If you have any questions, you can put them into the Slack, and we are going to resume this next week. I want to thank you for taking the time, and I will talk to you later.